at some point during this talk.
Dude, everything comes.
These guys don't let me talk about Palantir.
And I promise
we don't let you,
somehow,
but as soon as I put up anything on Twitter, it's like, oh, check out this cool new thing. Oh, well, Palantir did that 10 years ago.
Bro, no. But no, what happened this weekend is VITALY showed the floods in New York. I was like, oh, VITALY, everyone should just go to the metaverse. And VITALY, because I was making fun of Meta. And VITALY's like, well, Palantir couldn't solve it. And then some guy.
I did not say anything about Palantir.
Yeah,
you guys brought up Palantir while there's a flood in New York.
We were like, oh, Palantir would have solved this. There's no problem. VITALY got so mad. Like, fuck Palantir. Why are you talking about Palantir when there's a flood?
KRIS will chime in and be like, this is the reason why it's bullish for Disney cruises. Like, there's water flooding New York. You know where else there's water? On the boat. In the boat, there's pools. And people that are in New York will want to, and you're like, oh man, he's just.
Can you block a keyword on Twitter? Because it would make my life a lot easier. I might
you
do
can
that.
mute the word Palantir. You can do
Palantir.
that.
Just block it. Yeah.
Everything seems to come back to Palantir.
All right, let's give a proper introduction to the man, the myth, the legend, Jeremy Financial Education. Thank you for joining us on October 1st. I know you're a big Drake fan, OVO. I'm a Drake fan as well. Your birthday's not in October, though, right, Jeremy?
No, November.
Okay, November.
So I am a Scorpio.
Coming up. Happy
you
birthday.
Coming up Scorpio as well. So I could picture no one better than you to open up the month of October with us. Obviously, Jeremy, you guys will know him. YouTube legend, finance legend, has done amazing this year on a handful of stocks, and we're going to talk about those and have a fun episode.
Hey, I thought you were going to say when you were saying we're going to introduce a legend. I thought you were talking about KRIS. I didn't know you were going to talk about me.
The KRIS Patel, not the Bollywood actor.
I'm not that famous, guys. Come on, man.
KRIS, we were saying we went live right before you joined, and we were like, either KRIS thinks he's too famous for the pod and doesn't have to show up on time, or he's taking a shit because he's nervous. And he usually gets nervous before these episodes.
Nah, I actually was just making a drink, man. I woke ever since I started working the night shift. It's just nuts, man. Just like the concept of time is just out of place for me. So it's like sleeping when it's light out, and then working at night when there's no light. It really throws off like circadian rhythm. So this is usually the time where I wake up and then do the pod with you and then with Matt, and then I end up starting to work at 12. So it's just getting used to that.
Do you find, because I've been on a night schedule too, and do you find that you can no longer sleep 6 to 8 hours straight?
Yeah, I can't. I mean, I couldn't sleep 6 hours straight beforehand, but like now it's even worse. So I have like my cat naps throughout the day, which is not good.
Yeah.
So
you know what's gonna piss you guys off? Jeremy told me his sleep schedule. Jeremy, you want to tell them what time you sleep and wake up?
Well, yeah, and part of this is from when I used to work overnights. I think that screwed up my sleep schedule forever. But most of the time, for the past many years, I would go to sleep at like 2 to 3 a.m. and usually wake up about 10 a.m. So maybe 11 a.m.
That's a great life, bro.
What were you doing when you worked nights? Like, what was your last actual gig where you had to go to work and have a boss?
So that was Quick Trips. What really screwed me up, because I would work 2 nights overnights, and so you start at 10 p.m. and then you get off at 7 a.m. And then also you would even if you worked like a later afternoon or evening shift, you get off at like a little past 11. So by the time you're keyed down, you're not ready to go to bed till like 2. Because it's not like at least me, I don't want to get off work and go straight to bed. So
what is Quick Trips? That was your last job where you were an employee?
Yeah, it was manager of Quick Trip, which is like kind of like a retail gas station. I worked there until I was 24, so almost a decade now, because I'm about to turn 34. So, but I did it for I worked there for 4 years, and I worked late nights at Walgreens too. And yeah, so that was like 6 to 7 years of kind of like late night shifts. And so just naturally I started going to bed 2, 3 a.m. But recently I switched. So I'm trying to go to bed by like midnight recently. I'm trying to mature, I guess you could say.
Were you a good employee? Like, be honest.
Yes, very good.
Yeah, if you were the manager, you had to be the good.
And
reliable and like.
100%, man. I mean, anything I usually do, I want to be like the best at. And Quick Trip, it's a dog-eat-dog organization, but you have real opportunities. I mean, like real opportunities to move up the ranks, and you'll move up the ranks. Like whoever's the best is, it's probably the least political place I ever worked. There's still some politics in it, obviously, but the world is yours. And so like, I'd work like a dog. When I would do trash, when I was like an assistant manager, like entry level, I would run run to all the gas pumps and do the trash, sprinting. I'm not even kidding you. So like I was, I did anything to like out hustle any of my competition. And so that's how I got to move to Charlotte from Phoenix and kind of expand my way up there. So, but
I've never even heard of Quick Trips.
And Quick Trips actually pays well. Quick Trips actually pays well compared to a lot of other places. And coming from an Indian guy, that's got.
Did you work at Quick Trips?
He's like, I know a thing or two about gas stations.
He knows a lot. But Jeremy, would you agree that everybody has to go through sort of like that kind of experience where working retail or working some sort of I don't want to call it menial, but a lower end job in order to move up in the world, in order to become better at, I don't know, investing? It's sort of like a rite of passage. Is this something that you felt you had to do, or you could have skipped that?
Yeah, personally, yeah, it was almost like a rite of passage, but I didn't have other opportunities because, like I wasn't good in high school. So I certainly wasn't going to go to any big university. I went to community college. My parents didn't have any money, so they wouldn't be able to help me financially. So for me, it was the way out. That was the only way, I was working at Walgreens making like $8, $9 an hour. And in Quick Trip, I started at about 40,000. And I was like, oh yes. And then I did kick ass, got promoted to the next position like 7 months later, started making 50,000. And this is like 2011 at this point in time. And so for me, that was all the money in the world, like making 50K. Dude, I felt like the richest guy in the world. Like that was incredible, man. So
a long time ago, Carlos actually got me a job at Robbins. I don't know if you guys know what Robbins is.
We worked together. That's right.
It's a burger joint, right?
No, this was like a local like mom and pop
it's like a Walmart, but not a Walmart.
Really
like tiny.
They had clothes.
Walmart.
They had like an HBA section with like hair, beauty products, like shampoos, toothpaste, and stuff. And we were in there. And actually, we were the best employees in that place. You, me, and that guy, the black guy. I forgot his name. That guy was there forever. We were like running this shit. When the trucks would come, we would have the system where it would go right down into the basement and come right back up.
You guys weren't arguing about meta the whole time? While you
I don't think we knew about.
We were arguing about Pearl Jam.
Meta?
We were arguing about Pearl Jam because he was into like a certain kind of music that I was not into, and he didn't like my music. Although we were in a band together, somehow that worked.
All right, so let's get into it, Jeremy. Before we get into Elf and PayPal and Meta, I just want to ask you generally, how has the stock market been for you this year in terms of returns, your emotions, psychology, all that stuff? And then I'll let Chris start the discussion with Elf.
Yeah, so I have been kind of loving this year, to be honest. I mean, obviously, some of the big dog positions have been doing tremendous, like Meta, Tesla, Palantir come to mind. Those ones certainly have slowed down. They had that tremendous first 6 months of the year. So that's good. And then I always think about like not just current stocks I'm holding going up, but I'm also thinking about stocks that I want to build positions into that are going down. And there's a lot of those like value stocks, dividend stocks have been getting killed this year. They've been going through what big tech kind of went through last year. I was doing a video maybe last week, and I was showing like some of these companies have fallen 20, 25, 30% this year that you would never think about, like Dollar Tree and some of these sorts of companies. And for those stocks, like General Mills, Campbell's Soup, like for some of those stocks, a 25% fall in a year is like Meta or Tesla falling 50 to 70%. Like you never expect those stocks to fall 20, 30%. Like in a year, that's crazy. So I think we're getting a lot of value stocks and dividend stocks that are tremendous opportunities, which is pretty darn exciting. And then some hedges are starting to pay off a little bit. So we'll see how all that translate. But yeah, this has been kind of, a little bit of a, get your cake and eat it too, or whatever they say, one of those type of years. So, but hey, we deserve it. After last year, I got brutalized. So man.
And how much are you up on the year, the public portfolio?
Year to date might be 60 or 70%, something like that, probably roughly. So
not bad.
It's been tremendous. But like I said, it came off a very tough 2022. So man, it's
always the opposite. I feel like it's always the opposite because this year was supposed to be all about the value stocks in the beginning of the year. And then it wasn't about the value stocks, it's about the growth stocks. So I'm wondering at what point do they flip? Because I also have a dividend portfolio. I don't talk about it much, but I'm like, Realty is down. Still paying a dividend, still doing its thing. But all the REITs have been killed, as Chris knows too. It's like, it'd be interesting to know when that flips. Do you have any suggestion on when that happens? Like January?
I think 24, they start to come back to life. I think I don't think it's going to be as nearly as dramatic as like tech stocks went this year, where it was just up in a straight line, 100%, 200% gains. But I think they're going to slowly start to come back to life in 24 and then into 25. lot of those companies are kind of almost like recession proof. A lot of them do have big debt loads. That's the problem. And I think in this higher interest rate environment, that's concerning people of like, oh, what if they have to refinance debt at much higher levels and things like that. But I think eventually, I think people are going too far with the fear, no different than last year. I think they went too far with the growth stocks, the tech stock fear. And I think this year they're doing it with value stocks and dividend stocks. It's just not getting nearly as much publicity. But when you start going through it, the amount of stocks you can find right now, they're name brand companies. Like if I said it, everybody, you guys would all know it, right? That are at 5-year, 10-year, 15-year lows based upon what their market cap used to be. It's a long list of high quality names. So anyways, yeah, it's an interesting time. We'll see, how 24 shakes up. I see there being a lot of potential for 24. I mean, I don't know about you guys, but it's like, I see a potential where things get much worse and we start to see unemployment rise. I see another potential where it could shock everybody and we could actually go into a much stronger economy in 24. If we can get real wages to start ticking up more and more, because real wages went down for like 2 years straight. If we can get real wages start ticking up, inflation to keep at bay and not be as much of an issue, that would be a very good thing for us. And if we can at least get interest rates to stop going up, that might be helpful as well as a dollar chill out, a few things like that. So, man, everybody wants to know what's 24. And I'm like, I don't know, man. There's a lot of, this is going to be a wild year. There's several different scenarios that could play out. And it could be a boring ass year, which no, not everybody's expecting a boring year. Everybody's expecting some sort of fireworks. Maybe it's just one of those boring years.
You were one of the first guys to call, I forgot when it was. Maybe it was 2020, 2021. I heard you say on one of your pods, I think that Tesla, it was running up like mad. And you're like, I think we could see a year where it just sort of just trades sideways for a while. And that was unfathomable to me to think that it would do, but it pretty much did that. And so my question is, how do you see the fact that it's an election year playing into what 2024 could be?
That's the most underrated risk, I think, for the market that no one's really talking about. And maybe you guys are talking about, but I watch 1 million hours of CNBC and Bloomberg a week. I never hear anybody talking about really the election risk. And the fact that we've got Biden, who most people don't like or want, and then you got T-Man, who's got all the legal matters going on. Dude, I think that's a...
They're saying Newsom might jump in, but it's also like when you look at the social media companies, the amount of advertising that they're going to spend this fucking year is going to be ridiculous. So you could make a case either way, but will it be a good year or not? And also the Bitcoin halving event. There's a bunch of things that I'm just like, I don't know how this is all going to actually play out.
Yeah,
end up being a sideways year.
It could be, and that's why I'm remaining hedged going into the year. I got several hedges on for 24, and I kind of look at it. And I'm like, damn, there's some big risk out there. But on the flip side, maybe we're going to be okay. Election years can be very volatile, especially in that last 6 months. Mm-hmm. So there is a potential we could get a major shakeup kind of toward the end of the year.
How are you hedging?
I was going to say, especially if you get some recession fear kind of in the back half of the year as well. Ooh, boy. But go ahead.
Oh, Chris will be right there.
I know. I was wondering, how are you hedging? How are you actually hedging?
So, yeah, I got a few hedges on. I got Apple hedges, so put options for 24. I've got some Polaris put options, which Polaris, I think you guys probably know, makes like ATVs and just all types of those fun things with higher interest rates, potential, obviously, slowdown in people buying those on loans and things like that. That's a play. I've actually got some put options on Chipotle, which, that's, you don't want to bet against Chipotle long-term. It's a phenomenal company. But short-term, valuation is very stretched. They've come off incredible comps year over year. If those comps get, slammed in a major way, the stock will get crushed like a souffle, as Elon Musk would say. So I got those, and I got a couple other stocks that I'm kind of hedged against a little bit, just in case the stuff hits the fan. I'll save a little bit on the backside there.
1% of the portfolio, 2%, 5%. What are we talking about?
Probably more in the 2% range right now. Yeah, maybe 1.5 to 2%. So, but when it comes to those hedges in puts, it's like those can grow easily to 4 or 5% quickly without even putting in more money, just because the volatility there. Like if all of a sudden the SP 500 goes down 10, 15%, those put options, appreciate probably 100%, 200%. And, it happens pretty rapidly. So, but we'll see. Do you guys do any hedging, by the way? Guys, I actually don't know if you guys hedge at all.
No, the only person that hedges here is Chris. It's just Chris.
Yeah, the way I hedge, I sell.
That's not bad. That's not bad. Yeah.
You're right. You can't lose. You can't lose what you're not holding.
Yeah. Well, I think I'm in the same boat as you with the original thesis on the REITs and being value oriented. So, like, if you look at companies like American Tower, they're trading at like 5-year lows right now, which makes no sense because they have more towers than ever. And they're a critical component to every cell phone company on the planet, right? There's another one, Crown Castle. Crown Castle has been growing like crazy. 5G adoption is just happening everywhere. They own so much of the infrastructure behind it, yet they're going down primarily because there's a lot of concerns with like the Sprint and T-Mobile merger, that now there's going to be some cancellations on some of those contracts from Sprint, which is a legitimate concern, but it doesn't need to be sold off this much. You know, especially American Tower, they have like huge international expansion plans, and all they really do is just build towers. The cell phone companies put their equipment on the tower and they collect fixed monthly rent going into the future. Yes, they do have some leverage on their balance sheet, primarily because, you know, it's a capital intensive business. But I think with a slowdown, we're definitely going to see some cuts in the next year. So it's better to be positioned in an industry that's going to come back strong on the back of interest rate cuts, and do it now when no one is looking at it, rather than wait until the cuts start happening and then you have to pay a premium just to get back into the companies again. So if you look at their AFFOs, which are a much better way to look at a REIT. I know a lot of people, they look at things purely on a PE basis, and that was one of your questions on Twitter, which is like, why would you pay, you know, X amount on a PE? Like, is PEs even relevant anymore? And it all depends on the company and the sector that you're talking about. Some sectors are made for low PEs, some sectors are made for high PEs. And so, like, when you look at REITs, if you're looking at it purely from a PE perspective, you're missing it completely. You're supposed to actually look at the operating cash flows and how much NOI you're actually going to be able to get. And right now, a lot of my positioning, and I spoke to this, like my Patreon people, I'm looking at all these companies that have strong balance sheets, great dividends. And what's going to happen, in my opinion, next year is the yield chasing. Right now, everyone is like, oh, I can get 5.5%, on this, or I can get 4.5% on just treasuries. Why would I want to do that? But people forget that treasuries, if interest rates come down, those treasuries are going to come down. Those CD rates are going to come down. And then they're going to start looking for that 7, 8%, 9% dividend. And where they're going to get it, they're going to have to be buying a lot of these companies that have been sold off, that have strong cash flows. And by the way, that's the other thing about dividend investing that I made a mistake on when I was early in my investing journey, which is, oh, this company is only paying a 2% dividend. Why would I want to invest in it? But then if you look at it in like a long-term perspective, every year they've grown their dividend. And if you get into the capital structure at a price in 2009, your total rate of return by 2020 is close to 10 to 12% per year in just dividends on top of all the capital appreciation. So right now, I think there's a generational opportunity, like a once in a 10-year opportunity to get into like the REITs and a lot of value companies that are paying really good on dividends, that have strong operating cash flows, businesses that have tremendous moats around them. And, and for the next 10 years, you don't have to worry about it. You're getting paid to just hold these companies.
All right. Speaking of companies that have good returns, because we got to transition to this.
Yeah.
This is one that is up 98% year to date. Max up 300%. 5 years, if you got in the lows, up 700%. And it's a stock that Jeremy has done pretty well. And so, Chris, I want you to introduce why you got excited about this one and what kind of inspired this whole podcast. And then Jeremy has some slides I'll bring up as well.
Yeah. So it kind of started off with like a call that I had with one of my Patreon people. She was very shy about like investing and stuff. And one of the things is I was talking to her, I was like, I wish more females would be in the investing community, especially on YouTube and stuff, because if you're missing half the population and their opinion, then you're missing so many things. So I truly believe in a lot of the ways that Peter Lynch invests in is invest in things, but that also means investing, understanding where the value is from the other side. So none of us, I don't know about you guys, but I don't wear any makeup. But I know that it's a very large business. Yeah, I figured. But it's a very it's a growing segment. Like, it's half the world's population. Okay, is female, and the amount of females that are getting more and more into the workforce, developing and actually having higher levels of income is just growing exponentially. So there's a giant trend that we don't want to miss out on. And one of them is, of course, in a consumer product segment of makeup, which is starting to like really take off in a lot of parts of the world. Like if you go back even 30 years ago, makeup wasn't nearly the amount of business that it is today. So if you look at like the Rihannas of the world or the Kylie Jenners of the world, they became billionaires off of makeup. So one of the things Yeah. So one of the things I was talking to her about is just like, what are some investing opportunities that you as a female are seeing that, you're not really seeing? And one of the things I mentioned was like, I really want to do more deep dive into e.l.f. And then she started to tell me about all the stuff about e.l.f. because she actually uses their makeup brushes. Like she really loves their makeup brushes. And then they just bought like a skincare line. And that's when I started to really deep dive into their business model. And that's when I realized that, wait a second, this is a disruptor and an innovator that's just going crazy right now. Like, why didn't I look at this sooner? And I had heard Jeremy bring it up, but one of the things that just keeps coming to mind is like, oh, it's just makeup. Like, who cares about makeup? But when you start looking at the margins, you look at the repeatability of customers, you look at the growth in it, and then the verticals that you can get from buying different brands that may not be recognized and then using your distribution channels, you can actually grow the business significantly. So this is where the thesis for e.l.f. comes up. And so I know a lot of times the valuation right now seems really stretched for e.l.f., but I think that there's still a lot of runway for them to go. But, I'd like to hear Jeremy's opinion on this. I was like, for someone who caught e.l.f. much, much earlier, I'd love to hear what his thesis is and where he thinks the ultimate potential for this company is going to end up.
Yeah. So it's interesting. And obviously I agree with all those statements about, obviously females becoming a bigger and bigger part of the economy. And certainly it's been a trend for the last many decades and it's not slowing down. So, and then also, and it might be a funny statement to make, but females they spend more money than guys. It seems like, I mean,
they spend 80% of the consumer purchases are made by women.
Wow. I didn't know it was that extreme.
Well, think about it. All of the buying of the food, a lot of the healthcare, or not healthcare, but like childcare. You really think about it. I mean, the guys can only buy so many TVs. Like
we're still wearing the same socks we've been wearing 7 years ago.
Right. So literally 80 that consumer engine is predominantly women making the decisions.
Yeah, 100%. So Tarang, he's done a tremendous job running the company. Certainly, of CEOs I keep track of, I think he's done one of the best jobs of any CEO the past 5 years. But something I noticed, many years ago with him was he would use influencers. So this is around the time I was first starting to invest in e.l.f., 4 or 5 years ago. And he was doing, but he was getting some of these big YouTubers like Jeffree Star to review some of their products and whatnot. And I don't know if these were paid or organic or what the situation was, but you see the views there, 11 million views, other video, 14 million views. I'm like, oh my gosh. And then people would do reviews back to them. And I'm like, holy smokes, like this is one of the most viral kind of cosmetics brands out there. And this is going to be a long-term kind of tailwind there. And so now
how did this pop up on your YouTube feed? Did it just randomly pop up or?
I was searching e.l.f. back in those days. And then I would come across like these Jeffree Star videos and whatnot. I was like, holy smokes, these are getting a lot of views. And they just kept coming over time. And then people would react to some of the Jeffree Star. Because once you know how the algorithms work, it's like if e.l.f. is, popping and that's trending, then other makeup people want to start talking about e.l.f. And it just kind of like keeps going and going, right?
Kind of like Palantir, yeah.
Yeah, like Palantir. There you go. So, Mitt's like, oh no. So, anyways, that's a situation we had, right? And they've just put up crazy numbers. And so I circled in green there the numbers over the past several years, right? And the reason I circled those numbers there is every time I would always think like, this has to be the top for e.l.f. Like they can't grow faster than this. It's going to have to slow down, right? Like when they were growing 16%, I thought that. Then 24%, I was like, they can't grow faster than that. Like that's got to be the top. Then they grow 50%. Then, a few quarters ago, 49%. I'm like, that has to be the top. They're going to have to slow down. And then they do 78% growth, 76%. And so it's been a company that I've been investing in for maybe 5 years or so now, 4 or 5 years. And every share I've ever sold, I've regretted. I used to hold almost 10,000 shares of the stock. And I've regretted every share I sold, not just because the stocks went up, but the company, every time you think this has to kind of be the top, like they can't keep strengthening their business, can they? They do it. And then they do it. And they do it. And it's just one of those companies are like, dude, you got to hold on to every share you got. And so their business model is phenomenal, where basically they create high quality products that are almost as good as like more of name brand products, but for a fraction of the price. So Elf, is selling much around the $5, $10, $15 price points. And I don't know how much you guys know about like cosmetics industry, but it's very common for many cosmetics brands to sell at $50 price points, $100 price points on the higher end. Yeah. So
expensive.
Yeah, so they basically undercut on price in a massive way, and they're known for, if you want high quality for cheap price, you go to Elf. And obviously, if people are a little tighter on money because of inflation, then somebody like an Elf does really well in that environment. I know I got a slide a little later on that shows Elf versus Estee Lauder. It's crazy, but look at the net income. They just 3x'd their net income on a year-over-year basis. So obviously, it's phenomenal to see the revenue growth, but then you look at the net income growth, and it's far outpacing the revenue growth, which is very exciting. And you see, obviously, the EPS growth there. And so that's
here's that Estee Lauder slide. This one, actually, Jim Cramer's been talking about not buying Estee Lauder either. He's been very bearish about it as well.
Yeah, and by the way, Estee might actually be a buy for the long term. I've actually considered buying it very recently. I haven't yet, but I might step in at some point. But yeah, this is a great chart. This is a 1-year chart. Elf's up nearly 200%. Estee Lauder's down 34, 35%. Estee Lauder is known for the highest end brands, highest price points. Elf's known for super good quality for super cheap prices. And it's the perfect chart to kind of show you what's been going on with inflation, to be quite frank. People aren't going to spend on the higher end stuff. They're going to cheap out a little bit, and Elf benefits in a massive way.
What are they doing with all of that capital? How are they deploying all of that capital since they're making boatloads of cash? Where's it going?
A lot of it, they're reinvesting back into the business. So they're expanding retailers, which there's, usually a big upfront cost to expanding more shelf space into retailers, more products, marketing. They're putting a lot back into marketing right now. And the reason being is they have such phenomenal revenue growth that you kind of just want to keep that revenue growth piling up, because at the end of the day, a company like Elf is almost like a subscription business model, almost like a SaaS business in a little bit of a weird way, right? Where SaaS companies think spend, we'll worry about profits down the road once we have everybody in the funnel, right? And so if Elf can attract as many younger folks as possible, people in their teens, 20s, 30s, I mean, they're going to likely have customers there for 5, 10, 15, 20, 30 years. That will be loyal to the brand and continue to buy those products week in and week out, month in and month out. But the tough part with Elf is you look at the valuation, and we're trading at a forward PE, or roughly based upon this year's numbers, about 45 times. The market trades at 16, 18 times, something like that. So you look at that and it's like, whoo, that's up there. But you look at the growth, and they're outstripping the average company by way over 10x. I mean, if they're growing 70% plus revenues, I mean, the average stock in the stock market's not even growing 7%. So they're easily 10xing. And never mind that, on the net income growth, they're, 200%, 300% type growth numbers recently. So that's the tough part of Elf, is, are you getting a steal deal here or not? And there's if you go to that next slide there, AMIT, it was a couple points, I think it was back. There we go. So look at the gross margins on this business, because you would think, oh man, if they're selling products for $5, $10, they can't make any gross margins. The gross margins are insane. I mean, we're talking about like 70% type gross margins on this company, which is extraordinary. And, obviously you see the operating income there, the net income. So it's been a growth beast, but even myself, I'm trying to figure out to buy more or not. And I'm looking at it and I'm like, can they really keep this pace of growth going? If they can't, even if they could keep 30% going or 20%, damn, like if you can run that over 5 years, that's pretty extraordinary numbers. And you can make an argument that it's actually a cheap stock, even at a forward P of 45 right now. So that's where it's like, gets in the controversial stage of like, are you getting a good deal or you're not getting a good deal? And man, it's hard. And the last thing that kind of makes it hard is obviously the being up 1,400%. It's like, how am I going to buy a stock that I'm up 1,400% on? That's a tough financial decision to make, because just mentally, that's hard, man. Like really, I'm going to pay up that sort of price? I don't know. So that's just a mental hurdle you kind of got to get over, and it's something that plagues me all the time. But honestly, I regret every share I ever sold. It was the dumbest decision.
How many shares do you have left now?
That's it. The 1,000 shares.
Oh, okay.
And I had almost 10,000 shares at one point. So dumb.
What is their biggest expense?
Their biggest expense, well, they got several different expenses. Obviously, the product's a little bit of an expense. Selling general administrative expenses is quite a big expense. That was like 91 million. So that's a big expense for them. And they have hired aggressively. But if you're going to be growing revenue 70% plus, I guess it kind of makes sense. And if you're expanding more international, but it seems like SG&A is a big expense for the company right now. I'm hoping that slows down a little bit. But we'll see. We'll see kind of where things go there. But I mean, anyways, what do you guys think? Do you like it? Do you not? Love to kind of hear your guys' take.
For me, I think that their international expansion is going to be, I mean, first, this company is not new. This company's been around since the early 2000s, right? So the thing is, this is not something that just came out yesterday that no one noticed. So they have a lot of time where they were trading at a much fairer valuation than where they are today. But it just goes to show that once you hit this branding fire behind your name and that you have this mass adoption, you get that S curve. And I think that's what we're really early on. Because I mean, if you look at this company from a market cap perspective, it's only a $4 or $5 billion market cap company. It's not a significantly large company. So after just really realizing where they are in terms of their core products, what's next for them, and they just recently had this acquisition where they bought a skincare line. And one of the slides that really got me interested is these guys are in all the major pharmacy retailers. So most people that end up going to these pharmacy, like the Walgreens of the world, they're going to buy products like Elf and whatnot. But then they bought this other skincare line that doesn't have that brand presence in those pharmacies. And so what happens, it's almost like you're traveling in that same vertical, just you're broadening out what people are able to buy also. So I think that's where their growth vertical is, just from laterality of that angle. And then on top of it, their international presence. Because if you think about it, when you do a commercial, right, and you just put that commercial out, there's only one fixed cost for that commercial. But then if your branding presence grows, your international presence, you can translate those commercials into more customers. And then once again, it's just like you have this tailwind of notoriety that ends up getting translated around the world. And it just provides a SaaS-like business where you're not committing as much to SG&A costs, but at the same time, you're getting a tremendous more profit as you scale up. So
their hashtag on TikTok has about 500 million views.
Yeah, just goes to show you that they know how to do media. They really know how to do, and their strategy on social media is phenomenal. And they're just, I think this is an S curve for them. What we just saw over the last 3 months with a dip is actually a buying opportunity for this company. I think
but
that
even at a 40 PE, you think that's
but it's market cap. Honestly, I thought that the market cap would have been bigger. So the fact that it's still only say a $5 billion market cap, there's still a multiple.
It's 6.
Okay, so 6 billion. But I mean, to get to 12 billion, there's $12 billion lying around in somewhere in the market to be able to funnel into this. But the question is, how does it get there? And what do they need to do to justify that, right? That'd be the question.
So I just looked up Elf and Estee Lauder just to see, because I have not done enough makeup research, but 6 billion for Elf and PE ratio 63, and Estee Lauder is $52 billion with a PE ratio of 52. So in terms of their PEs, they're not that crazy far off. So if Elf does grow, it is a 10x. But that's assuming it goes to that sort of Estee Lauder, I don't know if it can get there. I have no idea. I've done no research there, but maybe Jeremy knows if it can get there.
The nice thing for Elf specifically is, many of the other big makeup brands, I know Chris was mentioning about in drugstores or whatever, in pharmacies. I mean, you look at most of those brands are owned by big conglomerate companies like Procter & Gamble or Unilever or whoever. And so these other big giant companies, they don't have the focus, because they own so many different brands that you're never going to get that focus. Like just Elf, Elf, all they do is sell beauty products. That's it. And so it's hard to compete if one company is only focused on that versus this big company is like that's our 30th most important brand to us. How much in resources are we going to funnel down there? And then who's really running that brand? And are their social media people nearly as good as the company that's focused on that full time, and all those sorts of questions, right? So, and that's why I think also why a lot of the influencer brands have done well in beauty as well. It's just a lot of these old brands and Maybellines and CoverGirl and all those, they had the business model on lock back in like the 80s and 90s when you could just run ads on soap operas all day
Or
and then
Avon.
call it a day. Yeah.
Avon.
Avon. Yep. Avon, the books, and then run commercials on soap operas and you were set. And it's
This
just
stuff is pretty cheap, bro. $9 is like, compared to Fenty Beauty by Rihanna, like it would be $50 for the same product.
How you know about Fenty Beauty?
Well, contrary to popular opinion,
I met a girl once.
No. I had a girlfriend at one point in my life. Okay, and I bought her some Fenty, and it was $50 for like some like little tube. I was like, "What is this?" But I paid.
Kylie, when she had that lip gloss shit in 2014, 2015, like you couldn't get that. You couldn't get it. Like I remember getting it for my girlfriend at the time, and I bought it like super early when she got it on Christmas. It was a very good Christmas for me.
One of the crazy origin stories.
It's like getting them a PlayStation. It's like she shows up with a PS5 the year it comes out. You're like, here's some lip shit.
One of the crazy origin stories is like the reason why the founders actually found this company was they were seeing like these rich.
Wait, no. The reason they founded the company is because they used to work for Santa, right? And they wanted to like build their own.
All right, continue. Ignore him.
Like Elf, they wanted to do their own thing. They revolted against.
That's your one corny joke. For
gotta be like they were sitting on a shelf.
This is what happens when you don't go to comedy shows. Your jokes are the worst.
So
it wasn't
what
bad,
happened was
it wasn't horrible.
Yeah, but the financial advice on comedy shows is pretty bad too. The flip side, you gotta take
the
all right.
The founders were driving, and one of the things that they saw was that a lot of rich women were actually still buying cheaper makeup products, like from pharmacies and stuff. So one of the things is that a lot of these brands that had existed for so long, they always just kept a high margin on their products, but there is a significant amount of demand in the lower end. So if you're able to provide the same quality for that lower end, you could definitely make it up in the margins. So yes, will they have to sell more to make the same margins as, let's say, the Maybellines of the world and everything else? Yeah, absolutely. But at the same time, they have this grip on the younger generation that now if you just are able to scale up significantly, you can actually disrupt the big guys. And because right now, if you look at Estee Lauder, some people actually consider it like, oh, that's an old woman's thing. It's like, oh, what are you, like 50? That's like your grandmother's brand, right? So a lot of people, they want newer things. They want to try out newer products. And if this company resonates with the younger crowd, that's all you really need.
Here, I have sort of a general question, and it's actually can apply to Alpha. I was thinking of it as a transition, but okay, with all the different metrics, like you mentioned the forward P, you're like, the fucking forward P is ridiculous on this thing, but the market is still giving them that multiple and will still continue to honor that multiple. So my question is, how do you figure out which is the metric that you're going to look at to determine what a company's fair value is, depending on the industry? So it seems like we can't look at forward P. Let's not even talk about forward P on ELF, right? And it's like for Tesla, it's the gross automotive margins. What are the margins? That's what people want to know, right? Mm-hmm. So how do you determine which is like the 1 to 3 metrics that you look at a company to decide whether it's fair valued or not? And how do you decide which is the ones that you're going to look at and say, you know what, this is why I still think this is a buy? Like on ELF, there's got to be a metric that you're like, this is still a buy because of this metric that might not be something like that you would traditionally look at with, say, another company or a different industry. Yeah. And do you do that based on each company or based on the industry?
100%. So I always run like basically like a super bearish case, a bear case, base case, bull case, and super bullish case on a stock I'm investing in. And I'll kind of take different growth rates that I expect for that company. So like my base case will be something, obviously my bullish case and bear cases will be something else. And then I'm really trying to look at it actually like 3 years out, especially if it's a big growth stock like an ELF is, and try to run numbers and say, okay, here's where I think their net income is likely going to be based upon all these factors in 3 years from now. Now work backwards. What's the market cap today? Okay, now based upon what am I paying for the whole company, I think about myself buying the whole company today based upon what I think their net income is going to be 3 years out. Am I getting a good deal? And do I think they still got a lot of growth ahead of themselves, probably past 3 years, right? And then you kind of work backwards on that. But that's where I'm having a little trouble with ELF, where I'm trying to run numbers and I'm not super confident in my projections. And the reason being is because I've been so kind of right and wrong on the stock, where I was right about the trajectory, but I was wrong about like, oh, this has to be the top. Even gross margins on ELF. I look at their gross margins every quarter. I'm like, this has to be the top. There's no way they could keep growing. And then they keep growing gross margins. I'm like, how the hell are they doing this? Like they're like such ridiculous gross margins already. I'm like, I don't get it. And they do it. And so that's where it gets really tough. But for stocks in general, that's how I do it. But if you guys got a different way,
I do have a question about the net income thing.
Net income.
Actually, yeah. Why are you using net income? Obviously, Alpha has a trajectory, but if you use it on a regular growth stock, net income really won't work because you want the company to be spending their cash to keep growing. So the net income wouldn't work. So what do you do in that case?
That's one of the things that say Gordon Johnson says about Tesla. That look at their net income, but it's like, hey, but they're scaling 2 factories. They got Cybertruck. They got this. They're spending some of their net income to.
I'm even talking about earlier companies, like so you could look at SoFi or whatever, and if you try to use net income to project growth, it's not going to work. So I'm curious about what do you do there?
Yeah, if I can't project you out, 3 years out, 5 years out, having positive net income, I can't invest in you. Bottom line. So even when I was running my Tesla, which when I first started investing in Tesla, they were losing money, but I believed that within 3 or 4 years, they're actually going to get to profitability and immense profitability really quickly. And if you look at like Tesla's net income, for instance, in 2022, it was very impressive if you compare it to what the market cap was when I was buying Tesla, which was maybe a $40 billion or $50 billion market cap. I don't know if you could pull up Tesla's net income from 2022. I can't remember it off the top of my head, but in 2021 as well.
Yeah, that was post-COVID. When we were in the middle of COVID, they were selling cars.
I think Chris is on it here. He's looking at something.
I would love to know those numbers.
Oh yeah, Chris. Yeah, pull up that alpha spread software you use, Chris. That'd be good.
Pull up that software you've been using, Chris.
That computer program.
No.
With all those numbers.
What company?
Digits.
What is it?
Which company? Tesla?
Tesla. Yeah, Tesla's net income 2021, 2022.
So really, that's the metric that you're using is net income. It's not. So then things like forward P don't matter as much, or operating income doesn't matter as much.
Free revenue growth.
Free cash flow doesn't matter to you as much.
No. I always go based upon net income. So what do we got here, Chris? Is this
Chris? Do the yearly. Do the yearly.
Yeah,
so this is TTM, I think. So let's do
trailing 12 month. Yeah, so they were up to $12 billion in trailing 12 month net income, which when I was buying Tesla was like a 40 or $50 billion market cap. So yeah,
it's like
so that's where it gets fun, right? And they even blew away my projections. I actually didn't have Tesla growing net income to 10 billion plus that quickly. They grew faster than I anticipated. So but anyways, that's how I do it. And if I can't be confident that you're going to be profitable 3 years out, 4 years out, 5 years out, I can't do it. It's a no touch. So a good example is one stock I'm invested in right now that's not profitable right now, but I believe they're going to be probably immensely profitable 3 years out, 5 years out. We'll see if I'm right or I'm wrong, but it's Fubo.
I knew it.
That's a money losing company right now. But based upon my projections, they will be making quite a bit of net income 3 years out and a lot more 5 years out. And we'll see. Maybe I'm wrong, but that's how I always do it. So I'm not saying it's the right way or the wrong way. That's just my.
But when so you're looking at the net income and whether they're profitable or not. You're saying to yourself, I do my projections for three to 5 years out, but I'll do my bear case, my base case, and then super bullish case. What are the metrics that you're plugging in, or what gives you the information, or what information are you looking at to calculate what your bull case and hyper bullish case would be? Is it previous earnings reports? Is it stuff that you're reading, say anecdotally, or what analysts are saying?
It's a combo. It's a combo of everything. So I'll take into account obviously what the most recent earnings were, kind of what's the trend going for the company at that given moment. I'll take into account obviously, like if there's experts in that industry, or if there's companies that are already well established in the industry, I can kind of look at where their margins are as like a goalpost of like this company's growing into this. I think they could be much more profitable than those past companies for XYZ reasons. So like Tesla, for instance, I relied heavily back in those days on like Sandy Munro, who's an auto expert. And he was basically doing these videos breaking down Teslas back then. And he's like, these cars are going to be far more profitable once they get to scale than internal combustion engines because of the way they're doing everything. And he broke apart how like, they were putting everything in just the computer monitor in the center of the console versus all these different buttons and how much that would save. And he would go into detail on all this. And then I would look at like, I know Kathy Wood gets crapped on a lot, but Kathy Wood and her team used to have a lot of good projections on battery cost for Teslas over time. And being able to kind of look at those and, the battery cost is going to come down this much this year. And then you can kind of run numbers and projections from there. So, if you want to admit, I can actually send you one of my kind of projections here in a minute. I'll text it over to you.
Sure.
But I would love to hear from you guys and kind of, you know, the way you think about it as well, while I kind of send him something over here.
Yeah, Carlos, what do you use? Do you agree with that net income, or do you kind of?
It surprises me. It surprises me that that's the metric, because that's something that, like, the net income is like what they have in the bank at the end of the day. But there's companies that are reinvesting so much into the business that I would think that it would maybe be more like an operating income, or what their free cash flow was. And if that's growing, that's interesting. I'm gonna go back and I'm gonna look back at, because I'm thinking now like say like an Enphase or an Innovix, and I'm like, how would that apply to those guys? Like, how would they just looking at the net income?
Go ahead, Chris.
To me, I think operating income is probably a better metric. It just depends on the industry, primarily because so much of the market right now is about returning capital to shareholders. So if you look at like the traditional companies like Meta, one of the things that you really had to dig into with Meta as a bull thesis was how much operating income are they generating, and then what part of that operating income is going back to share buybacks, right? So if you look at a lot of companies right now, you have your natural rate of growth that's going to be there, but then like
He's
if they
getting to
make
Google,
some
everybody.
changes, yeah, eventually I will. But when you start making operational changes that boost operating income, you can use that operating income as flexibility to do other things, whether that be through M&A, whether that be to what is that thing called? Buy share buybacks. And what that's going to do is boost up your EPS significantly. So when you look at it from a multiple expansion standpoint, if you've been trading at, let's say, a 20 multiple, like a 20, 25, or a 20, let's just say a 20 multiple, if you're able to grow your EPS significantly, you're able to, your stock price will follow suit and actually get better and better. So a lot of times when you looked at Meta, if you looked at it just on a PE basis, it was cheap. But then when you look at it from an operating income perspective and like how much money that they were going to save by doing a lot of the layoffs that they did, it was like the biggest no-brainer in the market, because you knew that with all the share buybacks, with all the savings on employee headcount reductions, that this was going to just moon to, to the next level. So I think a lot of times when you look at opportunities in the market, you have companies, their net income is, it looks like it went down a little bit, but then you look at their operating income and you're just like, there's a huge disconnect in terms of revenue and then their earnings, because it's like, how come their revenues are going up, but their EPS is going down or flat? And that's when you realize that the business actually needs to just make some corrective moves to right size the ship and grow their margins. And once they do those margin improvements, it just ends up, all that cash just comes back to shareholders. So I think a lot of companies right now, from a valuation perspective, look at operating income,
Okay.
When did you did these in 2020?
No, this is like Meta cases. I did these earlier this year, probably maybe beginning of 2023 or so.
Okay.
So right now I just sent over MIT, for instance, Meta, because I think there's a stock we're all aware of. I sent them over the ultra bearish case I have for Meta for the next few years, my base case, and then my ultra bullish case. But I have 5 different scenarios. So this is the ultra bearish case. This is a really bad scenario. This would be Meta putting up an average revenue growth of 3%, right? Because there's no way you can know for sure exactly what numbers a company's going to do. So you got to kind of project different scenarios, right? And this would be a scenario where their net income growth is an average of 1%. So obviously this is pretty pathetic, but that's why it's an ultra bearish case for Meta, right? So I always write down a bunch of different stuff there on kind of what I'm expecting. But then if we go to the market cap, you want
to go back there? Yeah, let me go back.
I just want to show them kind of how I think about PE ratios and whatnot. So then I'll run it based upon what I think their net income is going to be in that scenario. And then if the stock was priced at a 10p for that year, or 20p, 30p, 40p, or 50p, and what the stock. So for instance, let's say we thought Meta would be a fair value in 2027 at a 20p in this ultra bearish case. Then that means the market cap would be around $686 billion. And of course, things can move around because share dilution, share-based compensation, share buybacks, all that stuff. But just kind of looking at rough numbers, net income margin in this scenario would be 22.94% in 2027. So obviously that's pretty bearish. That would be a negative return over the next few years if that scenario played out. We could look at the base case and the ultra bullish case. That might be a little more fun. And I always run my numbers at like an average for the next 5 years. So what's the revenue growth average going to be? Because, you know, there's going to be recessions here and there. There's going to be 100-year pandemics. You never know what's going to happen. So just trying to figure out an average. So this is my base case. I have Meta doing an average of 14% revenue growth for the next 5 years. Net income growth, the same exact 14%. So no real leverage in kind of the bottom line there. And then in my base case scenario, if I think between a 20 and 30p would be pretty fair to pay for Meta in 2027, assuming their business model hasn't been disrupted in a massive way. That's putting at about a $1.1 trillion market cap to maybe a $1.6, $1.7 trillion market cap for my base case, which would still be quite a bit of upside from here, because I think we're sitting at, Meta might be sitting at, I don't know, an $800 billion market
780,
cap?
yeah, pretty much.
Okay. So yeah, basically about a double up from here, or just over a double up, depending upon which P you're looking at, 20 or 30. And then this is my ultra bull case. So I'm doing 22% average revenue growth a year for the next 5 years in this scenario, and then getting a little bit more leverage in that bottom line. So doing 25% on average. And then this one's a little more fun as far as the market cap. Because then if you say if they're growing 20% plus on average, you could probably command a 30p pretty easily.
Right, a higher P to that.
Yeah, and then you're sitting at about a $2.4 trillion market cap or so, given that scenario. And if they were really growing 20% on average, knocking that out year after year, you know, you could even make an argument for 40p in that sort of scenario. So, anyways, that's kind of how I work through the numbers and project out and whatnot. So
no, that's really
thanks
really
for
helpful.
that.
And then you
really
lean
helpful.
on. I assume then you lean on the base case. Basically, you're like, okay, the downside looks like it's $1 trillion company, so I really won't lose any money here. That's the downside. And if it goes crazy, we've got a $2 trillion company. That's what it looks like you're trying to project out.
100%. Yeah, I always put more value, obviously, in the base case than anything else. And even in my base case, I try to be a little bit more tepid and conservative, because obviously I'm going to be biased to the upside if I'm bullish on a stock and I own the stock. So even in my base case scenario, I try my best to be even a little bit more tepid in that. So maybe there's a little wiggle room for kind of beats there. So, but anyways,
maybe you want to put the link in the chat if anybody wants to ask Jeremy a question.
Okay, well, we got 2 more topics. Let me get these, and then we'll see if we have time for that. Jeremy, PayPal. So PayPal's taking a beating, 57, 58. It's been stuck in the $60 range. You've been quoted as like best value opportunity in the market. I know there's a lot of people here that care about PayPal. Can you give us a little bit?
How my spread's going to print me some money?
Yeah, PayPal. Man, you guys want to see my base case for PayPal?
Oh, let's do that. That's
that'd be awesome.
Okay.
Let's see.
Yeah, that'll be a little bit better than bringing someone up here, because I'm sure people really I know a lot of people.
Well, while he gets that, hopefully you hear the question, Jeremy. But Brad Gerstner, I'm sure you know him, the Meta investor, and also on the All In Pod and all that. He basically said he's going into, I think, 50% cash. He's expecting a big recession in 2025. I think that's what he's estimating last time he talked. So it was interesting to hear that someone who was so bullish about, obviously Meta going up. I'm wondering now if he's got rid of some of it because it went up a lot for him. So what do you think about all that? That recession 2025, that's what he's estimating. He went half in cash, somewhere around there.
He went half in cash now?
He's saying now this is the year to take out the money.
Bro, also remember this guy bought Snowflake at $425 a share. Like this guy is not the. I know we think Brad Gerstner.
That's so wrong. That's so wrong. Don't say that.
I know you're bringing that up.
No. You're absolutely wrong. You're
absolutely.
No. You're absolutely wrong. And let me tell you what, because he was an early venture investor in Snowflake. All right.
It doesn't matter. His public equity, his fund is holding a bag on Snowflake. That is undeniable. That is truth.
That's possible.
I don't care if he made money personally. His fund is down on Snowflake.
I don't know if we should shit on this billionaire, because he is a billionaire at the end of the day.
I don't know if he's the best proxy for a recession.
Well, my point is, he was sort of right, at least about the Meta thing. His letter is what instigated.
Everyone was right about Meta. That was obvious.
Well, no, his letter is what instigated for Zuck to sort of fix his house, and he probably made a shit ton off of it because he owns a big stake in it, and now he's probably sold some because he's getting ready for 2025. So I'm just curious, because Jeremy's a Meta bull, so I'm wondering, what do you think about what he's doing? Because he's on our team. Brad is on our team. All right.
Yeah. That's an aggressive move, and I mean, it's just so damn hard to predict. That's the bottom line when it comes to this macroeconomics. I mean, every macroeconomist expert was predicting at some point this year we're going to hit the big recession. A lot of people thought first half of the year, and these people spend all day, every day, just thinking about this stuff, and they were still wrong. And you think about it. So we talked a little bit about the election earlier, right? You've got Biden and you got T-Man. Both of those guys are actually pro-spending. Both of them are. Like, you look at obviously what T-Man did when he was in office, and you look what Biden's doing when he's in office. Both of them are pro-spending. So that's always going to create a lot of jobs. And obviously T-Man would be much more likely to do tax cuts if we had any sort of trouble in the economy of, trying to push through tax cuts. So that's going on. Obviously, if we get into any trouble, the Fed's going to start cutting. As soon as we start to, oh man, if all of a sudden unemployment goes, let's say we went to unemployment 4.5% or something, the Fed's going to start cutting rapidly because they're going to start getting scared. No different than they did.
But that's what I was going to say. Don't you think that the reason we didn't have that recession is because they've kind of engineered the soft landing? I just keeping rates
they have to stick it though. We haven't stuck the landing.
We haven't stuck the landing, but they're just keeping rates so high that they don't want that money flooding in. They don't want to open the floodgates. They don't want to pause, or they don't want to start lowering rates because then they feel like the money's going to flood in. Valuations will go crazy and then trigger a massive sell-off. I mean, I'm just throwing that out there as maybe that's
true. Yeah, and the one thing that's been holding us back this whole time has been inflation. And if inflation is much less of a factor, obviously in 24 and moving forward, then that gets the biggest boogeyman out of the room. Because let's not forget why we ended up in this whole fear of the last 2 years, interest rates rising crazy because of inflation. So there's a potential that is almost like a non-subject in 24. It's obviously becoming less and less of a subject this year. But okay, so this is my PayPal base case here. I think this is going to make some people pretty darn excited. But basically, I have them doing about 8% revenue growth on average a year for this next 5 years. And I have them basically about double upping their net income in terms of the growth percent there, and doing 16%. And if you look at like the latest quarter, for instance, that's a great example. On a GAAP basis, it's crazy numbers. It's like 400% growth. But on a non-GAAP basis, it's still, I think we're at about a double up or triple up of revenue right now. So I think it's pretty realistic that net income can grow at a much faster clip than revenue. And then if that all plays out there, you could probably slap a 30 PE on a stock like this, and you're at about a $217 billion market cap roughly, which we're sitting at a $50-something billion market cap right now. So that would be, and that's my base case, but we'll see. That's a net income margin there of about 17.7%.
And can you remind me, because I think PayPal sat in its history higher than 30 PE. I don't even think it was at that. I think it was 40 or higher. Am I correct in that?
Yeah, it used to be, very high. It used to be for sure 30 plus. And back in the day, there was some times when I think it was 40 or 50, to be honest.
You don't think it's coming back there ever again?
I think it's unlikely. I think we went through a fintech bubble. I'll be honest. Every fintech company out there, and PayPal is just one of those that got thrown into that. I mean, and it's funny. I remember being in the gym with Graham maybe a year and a half ago, 2 years ago, and I was telling him, because he was telling me, oh, this company just got this valuation. And I'm like, they don't even have revenue. And he's like, yeah, but they're basing it upon, they're getting like $100-something per user. And I was just like, this seems stupid. This seems like we're going through a fintech bubble. So that fintech bubble blew up. That's long over. That's why SoFi is a $7 stock today, and why, PayPal's $50. And I think it's gone way too far, but I highly doubt we're going back to 40 or 50 forward Ps on PayPal. That's just my opinion.
But do you not think that it's sometimes easier to justify a higher P ratio at lower market caps?
What do you mean by that exactly?
Well, in other words, like when you just look at the market cap in total, $50 billion is not that large. It's not that much physical money. So you wouldn't expect I feel like you wouldn't expect a 50 PE on a company with a $2 trillion market cap, because it's so much actual money. I'm saying the actual market cap is so big. So because of the relatively small market cap compared to the big boys, it's just the theory.
Yeah.
Highest P was 108. Look at that. Highest P 108.
But it was around 50. I think, Chris, are you sliding through? What was the history?
Yeah. So right now, if you look at PayPal's PE, the highest it had recently was around 96 in May of 2020. And then it slid down right now to like 15.8 PE, which if you look at like the MasterCard, the Visas of the world, relatively, if you compare them against each other, PayPal is a better value proposition than even Visa and MasterCard, with a tremendous amount of optionality in terms of margins for them. So if you look at, it's come down significantly in terms of PE. And then if you look at their operating,
what was the market cap relative to that? Like, what was the market cap when it was at 96, when it was trading at 96?
So look at May 2020, what it was. Yeah.
It got up to like a $300 billion market cap, if I recall, at one point. So it was bigger.
That was definitely bubble.
Jeremy, do you think Alex KRIS can fix this? How do you feel about him?
Yeah, so that's a little bit of a different view than I have. I don't think there's anything to necessarily fix with the business model. I think there's a few things he can tweak and get in a better place. But I think it's a broken stock. I don't think he's coming into a broken company. I think he's coming into a broken stock. And he has to just tweak a few things in the business model and ultimately get the story of PayPal out. I don't know. It just seems like there's a lot of boogeymen out there about like, well, Apple Pay, what's that going to do to PayPal and Venmo, and FedNow, what's that going to do? And all these sorts of things.
Don't do shit.
Yeah.
Like, we know it's not nothing.
I think the FedNow concerns are the only ones that are like keeping it literally where it is right now. Like if FedNow wasn't around, this would be trading at double the prices easily, So I think a lot of it is just speculation on their entire business model relies on that transactional revenue that they get from the interchange, of commerce. So the question is, okay, if FedNow comes around and the banks are able to do direct bank-to-bank transfers, these guys, their entire business model relies on that income. What happens? So it's all going to depend on FedNow adoption. If FedNow adoption never grows beyond a certain point, PayPal's a great place to be, because all that's happening right now is any additional income. Can you pull up my slide real quick, Amit? So if you just look at it from the perspective, like if their operating income, even like lately, they've been recovering. Their operating income had gone in December of 2021 from 4.3 billion to 3.7, which is the downside. But look at their operating income since. They've been able to right size the ship by doing, like I said, the layoffs and everything else. And that operating income now is going into buying back shares, which means on an EPS basis, it becomes even better in terms of valuation.
Yeah.
Because all that happens is now your profitability has not necessarily been impacted that much. So as their operating income grows, so do their share buybacks. And look at this last quarter, that net income spiked, significantly. Let me just do it on a quarterly basis.
And the stock went down.
What the hell?
The Fed raised rates the day after.
Jeremy, why aren't they looking at net income?
Hey, that's it. Oh, how are you just going to kick off?
Chris got so excited. He's like, I got to go buy some paper. I got to go to the bathroom right now.
It's Sunday, Chris. The market's not open. So, yeah, that's the beauty of being a stock picker in the market, because we're able to find these arbitrage of like, my opinion is Wall Street's got it wrong in regards to PayPal. And I think within probably the next 12 to 24 months, they'll realize they got it wrong. Last year, they got it wrong on Meta. Somebody was selling me Meta shares. I have Meta shares I bought last year for $88.94. Who the flip was selling me those Meta shares for $88.94? And now people are running over themselves to pay 300 plus. So that's the market. And that's the arbitrage. And that's the beauty of being a stock picker, where you're able to see these opportunities and you're like, this is stupid. Like I'm gonna risk a little money here. I'm not going to bet the farm on it, but the risk reward's there, and you can take advantage of it, or you can not if you don't believe in it, right?
I think we've all invested in PayPal at this point on this podcast.
Okay.
This is our boy. So this is Brad. He's up 91% on Meta. This is the last 13F. He's down 40% on Snowflake. Snowflake's the biggest one of the holdings. He's up 30% on Uber, 85% on Microsoft, 100% on NVIDIA, 160, and then 36% on Google. So we got Google, NVIDIA, Microsoft, Uber, and Meta right. The rest are kind of losers. Roblox down 50%, GitLab's down, and then Snowflake's the biggest loser. So he's done really well this year. So I think it makes sense that he's taken off 50%.
You got to be careful of where you're getting this data from, because you see this right here. This makes you think that he had a 40% average buy price, like much higher. That's not the case. He got into it, or Altimeter Capital got into Snowflake in 2015 in a Series C. They made almost close to like $4 billion on this company. So when you're looking at these things, be very careful with like how you're looking at it. I will say one thing that does scare me a little bit, in that Ackman went for Google. So Ackman's been loading up on Google, whereas Brad Gerstner has actually unloaded Google, because they're Brad thinks that there is a huge disruption in Google search coming. I mean, he sold it in like the 100. So I'm not so sure that his thesis relied on a lot of the newer projects that Google has with like, what is that thing called with AI? But yeah, it's crazy to see how two industry titans who've been very successful investors have differing opinions and thesis. In this scenario, I think I'm more aligned with probably Ackman than Gerstner, but we'll see.
Yeah. Hey, by the way, Chris, are you still bullish on Snowflake? Because I've been doing a lot of kind of little digging around on Snowflake, trying to see if there's something there.
Yeah, no. You ask anyone, the stock price right now, there's definitely a disconnect. But if you ask anyone in the industry that you work in with, and you can ask anyone, Snowflake is the go-to for a lot of companies. Like everyone uses Snowflake. They love the product and it's still growing. The only thing is like, it feels like an expensive value proposition if you look at it just based on today's numbers. But if you go like 10 years ahead, you'll see that this is actually a pretty good company to be in. You know, when it got to like $400, definitely overvalued. There's a lot of euphoria in there, but that typically happens with companies that, you know, when they come out during IPO during a bull market. They've got great leadership. They're still growing double digit. So if you just do the math on it and look 10 years ahead, Snowflake will be a good company to be in.
I mean, their net dollar retention is just ridiculous. I think that's the most insane metric for the whole company. I mean, just incredible. So,
Jeremy, how about you? Real quick, let's do the super chat then, Carlos. I got you. PayPal going woke. Any thoughts on that? I don't want you to get super political here, but is that a concern for the company?
No, I know there was something last year about that, but no concern in regards to that. All that stuff ends up passing by, you know. Even like Target got hit by some of that stuff this year. It's the type of stuff. It might hit you in a little bit in the short term when it comes to your numbers. At the end of the day, if people like products or services, they're going to use that and they'll get past it. So can it affect numbers in a quarter? Sure. But I don't think it affects numbers over the longer term. That's my personal opinion.
So I want to get back to something that you said right at the beginning of the podcast, and I've been thinking about it ever since then. We're talking about 2024, and you said you actually have a decent hedge position on Apple. And so I'm curious because they're supposed to release the first Vision Pros in early 2024. How do you see that playing out? And what do you see as like the bear case? Like, why would you think that Apple would get significantly hit in the year where they're supposed to launch a new product?
Yeah, so that hedge there is more just like if the market gets hit in general. Like let's say S&P gets hit 10, 20, 30%.
They're so big.
Yeah, and if the market gets hit, Apple's getting hit. And Apple's trading at pretty rich valuations based upon its historical norm of the past, let's say 10 years or so. And so that kind of gives me a little more wiggle room there. And that's why I kind of made that move. But in regards to pros, I think they messed up. I think this is a first real innovative product Apple's done without Steve Jobs or Johnny Ive. Everything, you know, Apple's ever launched was all Steve Jobs, Johnny Ive products, iPhone, Mac, iPad. And then it's just about, let's make it better, right? So this is a first product that neither one of those guys touched. Johnny Ive didn't touch, and obviously Steve Jobs did, and he's been gone for way too long, right? And Apple's gone with this approach of like super high end. I mean, you talk about it's going to be like a $3,800 price point out the door after taxes, right?
After taxes, probably at $3,500 retail.
Yeah,
it's not to say that it might not actually retail less, like probably $29.99, because they did the same thing with the iPad, where they announced it at a certain price, and then to give you that sense, there's a term for that where you announce it at a certain price, and then
it's called lying.
That's the term.
But when you do it as a company, it's not considered lying. As you know, you can get away with things as a company. It's whatever it was like a perceived discount. So if they would say it was $3,000 and you release it, people say it's high. But if you say it's $3,500, people are willing to pay for it. Then you say, you know what? We're going to put M3 processors in it. It's going to be $29.99. Boom. People feel like they're getting this idea of a discount.
That's sweet M3.
But yeah, so for Apple, they've always been the guys that are supposed to be like, get the younger generation on it. Cool. If we think about iPhone, it was all the younger generation was all who adopted the iPhone in the first several years, right? The business professionals like, oh, it doesn't have a keyboard. I want my BlackBerry.
It wasn't certified for enterprise for what, 4 or 5 years? It took security things.
Yeah, so it was the cool product. The younger folks are using it, college kids, high school kids, people in their 20s. Same thing with iPad. Freaking Jay Powell is now out there doing his press conferences with an iPad in front of him.
Yeah.
Like 10 years ago, you couldn't even conceive of that. Like what? Like that would be seen as so tacky. Like the Fed president's using an iPad. How ghetto? Like what? But so
you know,
anyway,
he's gonna come up there with those. He's gonna come up there with that headset on.
That would be funny.
And be like, I see the interest rates going up.
Yeah, so Apple's always had that approach of let's get the younger generation But the problem is the younger generation is not going to be able to afford this. So Meta is going to get the whole younger generation with the Quest 3 at a $500 price point. And so they're going to have those high school kids, college kids be able to use their VR and AR headsets. And I think that's going to push developers more faster. And I think Meta is actually going to win that race against Apple when Apple never really loses a hardware race. I think this is going to be the first one. But it's really, I think, because they got Tim Cook leading the show now, and I just don't think he's the visionary that Steve Jobs was and Johnny Ive were, where they could think about this stuff practically and be like, we need an iPod because the cool, at a cheap price because all the kids are going to adopt it and then their parents are going to buy it and it's going to be this great thing, right?
So you think growth will slow on the hardware side, but you don't think services that they've been killing it on will make up for the lack of the hardware growth?
I think it could longer term. I think services, they're going to nickel and dime all of us that are Apple customers for years to go in the future.
They're a toll keeper.
Yes, they're going to go up on
I
cloud.
did go to my taxes today, by the way. I'm late, but I'm looking at how much I spend on different companies. And so, there is an Apple tax for me just in terms of like the $9.99 they charge me. I pay for the
iCloud storage, the
iCloud storage, all the little games that you keep buying that you don't know they add up.
Yeah.
So there's probably like $500 going out the window just on services. So that,
or even like my ESPN subscription for something like this is weird. I go to ESPN.com. I subscribe to
Apple,
it. It freaking shows up in my Apple ID,
and they take 30% of that.
And they're somehow getting paid for it. I have no idea how they've stuck themselves in the middle of basically
everybody. Yeah, it is. There is an Apple tax. It's real. I have two questions real quick. One was, do you actually use PayPal?
Yes. Yeah. By the way, a story for you real quick in regards to that. I never have ordered anything from DoorDash before, but I wanted to because they got Cheesecake Factory in North Italy on there, and I own Cheesecake Factory stock. Yeah,
we got to do it again, Vitaly.
So I download DoorDash, and it gives me 5 payment options. One, obviously, credit card, debit card. Right underneath that was Apple Pay. Right underneath that, PayPal, Venmo, and then Cash App. So, anyways, that's just something I like.
So did you use PayPal because you want PayPal to win, or you use it because, it's the service you use?
It's the easiest because I click it, then it does Face ID, and boom, it's right through. So I maybe Apple Pay would be that easy, but it's just like PayPal. I'm just so used to like clicking PayPal, it reads my face, and then boom, it just pays for it. So.
Yeah, no, I use PayPal a lot. I actually looked at my PayPal transactions today too. They're immense. The second question, which I guess you guys can end, I'll end off on this. Amazon. So I think you've been buying Amazon, and it's sort of reasonable right now. And I'll give you a side note here. I'm all in tax mode because I'm late. I'm always late every single year.
Me too.
And I spent $24,000 in Amazon last year.
2022. You or did your wife spend that money?
No, me. Not even counting her. I'm doing my own taxes, and there's business taxes because I buy things for Amazon. I have multiple properties, so I'm like, holy shit! On Monday, I am buying more Amazon. I did not realize I spent $25,000 on Amazon.
That's crazy.
I had no idea, by the way.
No, I'm around there too, between the impulse purchases and then your reoccurring stuff.
Just these little things that add up, and then obviously there's bigger items that I get anyway, like for film equipment or for real estate. So my question to you is, how bullish are you on Amazon? Because I can't believe I'm basically supporting the whole company.
Well, dang.
By the way, Jeremy, when I came to your house, I handed you your Amazon package because it was at the door, right? There's a lot of Amazon packages.
I remember that. You know what? That makes me. I'm gonna pull up my Amazon base case for you guys.
I do want to see
that net income, bitches.
I've never been more bullish looking at my taxes. Why am I not spending more money buying the Amazon stock because of just the amount of money I spend on the actual website? It's crazy.
And you guys keep telling me, I didn't even know this. You guys keep telling me that cloud is still 90% on-prem. I didn't know that. So if that's the case, then AWS should still have some room.
Yeah, I mean, AWS has a ton of growth ahead of it. Like, it's not even like remotely questionable. But I think more importantly, once again, if you look at their operating income, it's been growing like crazy, especially the last quarter. It just spiked up crazy because they had spent all this money on capital expenses after COVID, around COVID, to basically support all the deliveries for COVID. So what ends up happening now? You end up seeing a lot of that CapEx being rolled back, headcount reduction, and now their operating income is just going crazy. So if they get back to their operating income, which they were previously, like around here in 2021, this is easily getting to about, you know, what the same prices were at the time, which I think like what, 178 ish, 179, something like that. And it's just going to keep growing further and further. So I think right now, Amazon, once again, Google's a good play, but Amazon is probably even a better play in terms of recovery potential. So definitely going to be adding more Amazon.
It's interesting you said that, because I do have a way bigger position in Amazon, and I was looking, do I buy more Google or Amazon? But the amount of money, I was literally shocked, because I look at how much I spend on Google too, and I do spend a bit on there, like cloud storage too. Nowhere near what I spend on Amazon. Just nowhere. Yeah. It's night and day.
Wow. Well, remember, it's all about margins too, right? Like when you're buying something from Amazon, you're not exactly like, Amazon's not getting a lot of margin, whereas Apple is getting 80-90% margin. So there's a big difference.
I was comparing it to Google, by the way. I was comparing it to Google.
Well, even Google,
but it's just more about how entrenched they are in your life, how important. Like if Google went away, we'd be fine. But if Amazon went away,
I don't know about that.
Yeah, smell. I wouldn't have deodorant. We'd have no shampoo. Like
I think
I gotta go to CVS. Like,
the biggest value case for Amazon right now is their shift over to their higher margin businesses. So AWS has always been a grower for them and a really high margin business. But then their ads business, if you look at their ads business, it is just growing like crazy. It's massive. So that will add significantly to their operating income. And I think eventually they'll announce a really big share buyback, you know, starting probably next year. So we'll see.
Okay.
I think my my last question, if we can go full
screen. Well, I think he's doing the Amazon.
Yeah, go ahead, Jeremy.
Yeah.
Oh yeah. Anyways, this is my Amazon base case. And so I did this end of last year, probably beginning of this year. And when I was thinking about this base case, I did factor in, I didn't write it out there, but I did factor in something was going to happen government related that was going to be negative for the company. And so that was going to hold back growth.
You nailed that one.
Yeah, from what they could do. And so, you know, this could actually be very conservative numbers, 12% revenue growth on average in the next, 5 years or so, and net income growth of only 18%. But anyways, that's kind of my numbers I got there, getting to close to about $60 billion in net income 2027. And then $889 billion of revenue 2027. My bullish case and my ultra bullish case actually have the company over.
Can you scroll down on this?
What do you have as the PE for that?
Yeah, what is the where are you aiming for?
So you could probably value at about a 30 or maybe a 40 PE. So you're like 1.7 to maybe $2.3 trillion market cap in this scenario.
I mean, Amazon's always valued more than the PE doesn't work for Amazon. So it's always 50, 60, 70.
It's always going to trade rich, no different than Tesla. Tesla and Amazon are their own freaking category. They're always going to trade rich. Someday they'll trade cheap, but it might be 5, 10, 20 years from now.
I think it's 20 years, and that 3 trillion probably makes more sense than anything.
It's always when those companies have very different, like diversified sort of revenue streams, when they're almost like an ETF unto themselves. Some people might value this business more than this business. And so it gets hard to find like what an actual multiple is on the whole company.
100%, but 24,000. That number's shocking to me, man.
It's shocking to me. It's shocking to me
that you guys don't spend that much. I mean, where are you buying all your shit from?
Dude, I impulse bought some $7 rings yesterday because I was like, yo, I want to wear some.
So you went to Armani Exchange.
Rings.
Like, yo, this is cool.
No, but what's funny is I ran to my wife. I'm like, oh my God, I spent 24,000 a year because today I'm doing. She's like, oh, I spent only 10, so that's 34,000 between the two.
Guys, this beanie is from Amazon. This shirt is from Amazon.
Anyway, that's a lot of money. Jeremy, you probably spend more than 34 grand, I'm sure.
Are from Amazon.
Like underwear is from Amazon.
No, the underwear is not from Amazon, but everything's from Amazon.
One of their big growth drivers, I think, in the future is going to be around enterprise spending on Amazon. If you look at and how enterprises typically spend their money in the past, it's usually you have like a certain website that you're connected to that you can buy like paper, pencils, all this other stuff like that corporations tend to buy. And now Amazon is kind of like partnering with a lot of companies where you can buy stuff on Amazon and actually do like a 30-day net receivable and everything else. So like enterprise spend, if you end up partnering with Amazon because their delivery is so quick, efficient, and you're able to get all the products you need that are there. If you've ever been in purchasing, you'll see that like sometimes you have to go to like staples.com or WB Mason to buy something. And it's just like, man, I could fucking buy this like 20% the cost if I just ordered it through Amazon. I've been in that position. And so it's one of those things that enterprise spending. No, I'm saying Right, but I'm saying on the enterprise level, if they're able to nail in a lot of big enterprise clients where, if your purchasing manager just has to go to Amazon, log in and buy stuff on Amazon, and it's a quick, easy process, dude, that is a lot of spend that's going to be coming towards Amazon that traditionally has been done through like Staples or through, like the other retailers
Office
out
Depot.
there. Yeah.
By the way, I have heard through the grapevine, let's just put it that way, that AWS is facing quite a bit of pressure, not just from internal customers, which is something they've been dealing with, but I have heard Google is potentially even losing money on some of these deals to outcompete Amazon, and where Amazon is losing out some deals to Google just because Google's in a tougher revenue state right now for several different reasons. And so they're just growing by any means necessary. And even if they got to sell at cost or lose money. And so some companies are like, oh, we're going to have to go with Google because they undercut AWS by 10%, 20%, 30%. And it can be pretty big numbers. So that's all I'm hearing. So don't be surprised if AWS faces a little pressure over this next 12 to 24 months from not only Microsoft, but also Google, who's maybe a little bit desperate. And you never want to deal with a desperate, company. So I don't know. We'll see.
Yeah, agreed. All right.
I have a sort of off kilter question, something fun to end it on. So when we're in Vegas and AMIT does get too drunk and hammered, and can we count on you to bail us out of jail if?
I'm coming to Vegas all of us are coming on the 26th and 30th for my birthday, and we're gonna be on the Strip. I know you live a little bit farther away, so if you can come on the Strip and chill, that'd be awesome. But I know it'll be at end of October, that last weekend in October. We'll probably all be gone that Monday before Halloween, but that weekend, 27, 28, 29, 30, we're going to be around. We're going to go to we're going to go see Absinthe. You've been to that? Absinthe?
I haven't, but I've seen it. I've seen of it.
We're going there. We're going to do some Top Golf. Maybe you can come out and hang out with us, but
I'm sure some people want to go to Planet 13. I was like,
no. Yeah, what we're doing, I need to find out exactly what day you guys are coming in. Poker game, my house, the very night you guys freaking get in.
Oh man, that would be fun.
I'm down.
I'm down.
I need to make sure I get you guys the moment you land in Vegas, because Lord knows by the time you're going to leave Vegas, you ain't gonna have any more money left.
That's what he's doing. He literally is like, I want you to come to Vegas and give me all your money.
No, that would. So me, Chris, and Matt Money, we get in on the 26th.
Okay.
V might not make it. He might have a work thing. Carlos definitely is not gonna be here until Saturday. So I'll text you.
I'm getting there the 28th around like 11 noonish, and I'll be out that Monday to come back for work that night. So
Okay, cool.
But I'm in LA, so it's a
bro.
If you AMIT and Chris have a poker game, I'd like to see at least a part of it. Get some video.
We'll make it happen.
When these guys see the view of your house, because you just live in a beautiful house, and like the view behind it, that's in your videos all the time where you're doing video. It's just incredible. It's beautiful. So, I looked at it and I was inspired. I was like, this guy worked at Quick Trip, and now he wakes up every morning and looks at these mountains. Like, it's beautiful. It's insane.
I appreciate it. But yeah, we'll definitely get it together. If for no reason we can't do poker game, which is my preferred thing, then we'll do Top Golf for sure. But
very nice.
Yeah.
Okay. Cool.
We'll probably do that one in the afternoon, one of those days. Like maybe I think we have that for Saturday, right? Saturday.
Yeah.
We'll go do that. We're still trying to figure out what to do Saturday night. Maybe we'll do
this would make VITALY so happy.
Yeah, we can use Quest.
We're like, yeah, why show up to your house?
Yeah, Jeremy, you want to play some chess in the metaverse?
Jeremy, thank you for joining, man. We really appreciate you taking your time.
So
this
much.
is awesome.
Yeah.
Everyone, make sure to follow on Twitter and YouTube, and keep doing your thing. You're the king of this YouTube finance game. You're running it. It's just your world. We're in it.
Yeah, thanks, man. It was great talking to you.
Appreciate it.
Appreciate you guys having me on. I'm glad I was able to make it. So thanks so much. And hopefully see you guys maybe in Vegas some point this month. So
end of the month.
Appreciate
you guys. Thank you all for joining. We'll see you tomorrow.
Bye,
everybody.
Bye, everybody.